Welcome to this explainer. Today, we're diving into a tiny, completely under-the-radar semiconductor company that literally just caught the entire market off guard. We're talking about an 81% jump in quarterly revenue for a business that, honestly, most people have probably never even heard of. It's called NVE Corporation, ticker symbol NVEC.
So that naturally leads us to the big question on everyone's mind. Is this the next AI winner? Could this completely unknown company be the actual hidden gem of the AI boom? Well, here's the twist. NVN doesn't even make GPUs. They aren't NVIDIA, they aren't AMD, and they certainly aren't out there building massive language models. Yet, all of a sudden, investors are paying very, very close attention.
Okay, let's look at this absolutely staggering number right here, 81%. On July 22nd, NVE dropped their results for the quarter ending June 30, 2026, and their revenues surged by 81% compared to the exact same quarter just a year ago. It's the kind of sudden, explosive growth that forces the market to just stop and take notice. But to understand why this is happening, we really need to know what it is they actually do.
All right, let's dive into this and clear up exactly what NVEC isn't and what it actually is. They're not going toe-to-toe with the heavyweights pumping out AI chips for data centers. No way. Instead, NVEC is a tiny spintronics sensor maker. They're essentially building the physical infrastructure for AI. Think about what happens when artificial intelligence leaves the computer and enters the physical world, into robots, automated factories, and smart machines. Those systems actually need to sense their environment, right? Well, that is exactly what NVE builds.
To put the sheer scale of that leap into perspective, we're looking at quarterly revenue vaulting from about $6.1 million in 2025 to roughly $11 million in 2026. I mean, for a company of this size, adding almost $5 million in pure top-line revenue in a single quarter, that is a massive acceleration. But hey, the top line is really only half the story. Let's see how that revenue actually translates to their bottom line. The revenue didn't just go up, it converted dramatically into higher earnings. Net income, up 79%. Earnings per share practically doubled, jumping from 74 cents to $1.32. But you've got to look at that last number, an 81.3% gross margin. That is absolutely extraordinary for a hardware-oriented company. When they make an additional sale, a massive chunk of that revenue flows straight down to operating profit. It is literally a margin machine.
Now, what's really interesting about this slide is the core technology driving those incredible margins. It's called spintronics. I know, it sounds like something straight out of science fiction, but it's actually highly specialized physics. Basically, NVE utilizes the spin of electrons, not just their electrical charge, to build highly sensitive magnetic sensors and couplers. Simply put, their sensors acquire information from the physical world, and their couplers transmit that information straight to the electronic system.
Let's break that down just a bit further so we can really wrap our heads around the underlying tech. Traditional electronics, the stuff in practically everything you own, primarily rely on the simple movement of electrical charge. Spintronics, on the other hand, taps into a whole different quantum property of electrons, their spin state. By utilizing this, NVE can create components that are incredibly precise, highly efficient, and perfectly suited for the deeply complex sensing required in modern intelligent machinery.
So where does this actually get used out in the wild? Well, look at these real-world applications: robotics, industrial machines, sophisticated medical devices, and automated systems. As AI pushes these machines to become smarter and more autonomous, they need a way to feel and interact with the physical world. If AI is the brain of the operation, NVE's spintronic sensors act as the nervous system, feeding crucial, real-time physical data right back to that brain.
And that brings us to a really grounded investment thesis. The question isn't whether NVE is going to be the next NVIDIA. Honestly, that's just the wrong story. The real quote to focus on is this: what happens if the AI revolution creates more demand for the exact kinds of sensors and components NVE already specializes in? That is a much more realistic, tangible way to look at this company. They are a true physical world AI infrastructure play. And the thing is, they are actively expanding that infrastructure footprint. In 2026, NVEE rolled out a whole slew of new products. We're talking ultra-miniature magnetic switch sensors and highly specialized MRI-compatible medical sensors. They also have a really strong foothold in defense applications. In fact, in their latest quarter, product sales shot up 82% across both defense and non-defense lines. This proves we aren't just looking at some passing AI hype story. It's a remarkably broad investment case spanning multiple high-need industries.
Now here's the number that might actually surprise you for a high-growth tech stock: $1. That's NVE's per-share quarterly dividend. Now, some recent hype has pointed to this as if it's some brand new, massive shareholder return program. But let's fact-check that right now. NVE has actually been paying this $1 quarterly dividend consistently since 2015, so they didn't just suddenly discover dividends. What's truly impressive is that they managed to combine very high margins, strong cash generation, and consistent shareholder distributions all at the exact same time.
Okay, let's dive into this next piece of the puzzle, the capacity bet. NVE recently completed a multi-year facility expansion to support the production ramp-up of their newer products. Now, this is a crucial reality check. Expanding capacity isn't just an automatic, guaranteed win. It is a massive bet on future demand. If automation and robotics demand continues to accelerate, this extra capacity is going to be incredibly valuable. But if that demand arrives slower than expected, they could be left holding the bag with costly, unused manufacturing space.
Alongside that physical expansion, there's also been some leadership evolution. Back in June 2026, NVE promoted Peter G. Eames to CEO. And we really have to weigh the delicate balance this creates. On one hand, we have excellent leadership continuity. Eames has been with NVE since 2003, providing a super steady hand on their technology strategy. But on the flip side, you have execution risk. A nice headline is great, but the real test is whether the new CEO can maintain those extraordinary 81% gross margins and actually translate their technology pipeline into sustained commercial growth.
Because guys, here's a number that puts literally everything into perspective. 42. They have just 42 employees. NVE Corporation operates with a remarkably lean team and roughly $48 million in cash and marketable securities. They are incredibly small. And this tiny scale is exactly what creates both their incredible opportunities and their sharp vulnerabilities. When your starting point is this small, landing just a few new contracts can double your revenue overnight. But remember, it cuts both ways.
Because of that tiny scale, we absolutely have to take an objective look at the fundamental risks here. Their vulnerabilities include a heavy reliance on just a handful of large customers. Plus, they're heavily exposed to the broader, often cyclical semiconductor market. But perhaps the most dangerous risk of all right now? Sky-high growth expectations. When you post an 81% revenue jump, the market suddenly expects you to do it again and again. One bad customer decision or a weak market cycle could be devastating when everyone is expecting perfection.
So, what does this all mean? How do we weigh all this information? Let's reduce the NVEC story into three possible futures, starting with the bull case. In this scenario, NVEC's new products completely thrive. Demand for automation and robotics booms globally, and the semiconductor cycle remains highly favorable for them. Thanks to those massive margins, earnings end up growing even faster than revenue, and the market rewards NVEC with a premium valuation for flawless execution.
Next up, we have the base case. This is a highly realistic scenario where that eye-popping 81% growth rate eventually comes back down to earth and normalizes. But the company still maintains healthy, steady growth. Their strong dividends continue to flow, and those new products gradually win market share over time. In this future, NVE doesn't become some mega-cap giant, but it remains a highly profitable, high-quality niche technology business.
And finally, to maintain total objectivity, we have to look at the bear case. In this scenario, Q2 turns out to be a total anomaly. Just a brief, unusually strong quarter. Growth slows dramatically, the broader market's enthusiasm for AI starts to fade, and sales of those new products just stall out. If that happens, investors who chase the stock in its absolute peak will find that they paid way too much for future growth, and the stock could fall sharply.
So, the ultimate question we are left with is this. Is NVEC a massive new growth story, or have we literally just witnessed a peak quarter? We've got this tiny, highly specialized company building the sensory nervous system for the physical AI revolution, backed by sudden 81% revenue growth and huge margins. But they're small, the expectations are towering, and they still have to prove this wasn't just a one-off event. It's a truly fascinating setup, and the next few quarters are going to give us the answer. I hope this explainer gave you a clear lens to view this incredible market story. Keep an eye on NVEC, because what happens next is going to be very interesting to watch. So, what do you think?